All right, what's up, folks? Happy Tuesday morning, 8 a.m., April Fool's Day, April 1st, 2025. Let's talk through some key charts here. A lot of confusion going around, a lot of people throwing out numbers, trying to definitively call a bottom, as is and will always be the nature of Twitter or any other platform where people can hop on and give their opinions freely. They will give their opinions freely. Unfortunately, up until yesterday, every single person that has called for an absolute bottom in the market has been wrong. I think that's a defining feature of a successful long-term trader or investor is not trying to get in the way of these trends. Understand that trends tend to trend longer than most people expect, and simply to trade along with them. As of right now, throwing on something as simple as a 200-day moving average across these major indexes can save you from a lot of pain. Not calling a bottom until minimum we're up and over that 200-day moving average with some supporting evidence. It doesn't make any sense to me to continue to sit here and try to buy these dips. Eventually, the market will find some sort of floor, whether that's tomorrow, post-tariff announcement, whether that is a year from now, 2 years from now, who knows when it's actually going to be. But I have no problem sitting here and waiting for positive divergences coming in from a momentum standpoint, breaking up and over key levels, and then starting to initiate more buys, particularly in the growth areas of the market. If we look at something as simple as the S&P 500, just waiting until we're back up and over the 200-day moving average not only will keep us out of trouble, but it will also increase the probability that the buys that we take in the future are going to work out. Things like Mag 7 that everybody is just continuing to buy the dip, a lot of that comes to recency bias. A lot of that comes down to conditioning. A lot of people that are trading and investing right now have probably only been trading and investing since 2020 or 2021, and they really only know one type of market, which is buy the Mag 7. Unfortunately, if we go back through history, there are periods of time where Mag 7 has underperformed for almost 10 years straight. Go back to 2000 to 2008. You had an 8-year run where Mag 7 absolutely got stomped. I think it took Microsoft 17 years to get back up towards all-time highs post.com. And I'm not sitting here saying that's going to happen again, but I am saying that that's something that most traders and investors that are looking at right now are simply not taking into consideration. We absolutely could be in that type of environment again at some point. So something to keep in the back of your mind. As for us, we're looking for a move up and over the 200-day moving average. We're looking for an RSI up and over the 50. I think that's pretty straightforward stuff here. Using something as simple as a 200-day moving average to gauge risk really can improve your profitability over the long term, but it takes a lot of patience to not want to buy some of these stocks below the 200-day moving average. Ego and opinion tend to come in. You want to call a bottom, you have a bias, and the 200-day moving average really doesn't give a shit about what you think. It's just there. And so we like to respect it inside of TTI because there's a lot of data going back to support the fact that if we're trending below a 200-day moving average, prices tend to continue to go down. And once we're back up and over that 200-day moving average, prices tend to continue to go up. It's just that simple, folks. So that's what we're looking for. Kind of general thoughts here with the Qs and the S&P. The NASDAQ obviously a lot worse off than the S&P 500. Growth sectors and industry groups continue to get crushed, particularly tech. Tech just absolutely is not catching a consistent bid whatsoever across the board. There were pockets of relative strength over the last couple of weeks, but I think Friday really hosed a lot of people. But on the flip side, shorting into late last week or potentially even yesterday was equally as disastrous as trying to long some of these relative strength components over the last 2 weeks. This is a very challenging market to want to commit to anything more than very quick kind of in and outs or playing some sort of options trade that takes advantage of elevated implied volatility. Shorting the whole, as it's known, is incredibly difficult. You have reversal days like we had yesterday, and right now I think pre-market we're down another 0.5% in the Qs after just an enormous move to the upside intraday. Yesterday, we had a 1 to 1.5x ADR move, I believe. We can go ahead and throw that on there. With an ADR at 2.17, we can go ahead and look at the ADR on the move. This was well up and over, almost 1.5 ADR move to the upside in the Qs, meaning that everybody just got absolutely blown out of the water that was shorting into the hole in the NASDAQ. We had tech that closed green or right there at break even. All 11 sectors were up as of yesterday's close. Very, very difficult conditions from a swing or a position trading standpoint to want to throw shorts onto the books right now, because what we talk about inside of TTI all the time, at least in the Discord, is simply that puts are designed to go to zero by nature. They're very fickle. They're difficult to trade in certain circumstances. I think people liberally use puts as a way to express downwards bias, and it's just not that simple. If you're buying puts in the wrong type of market environment, you're going to get blown up, even if you choose the right direction, which is more than half of the battle to begin with. Yesterday was a great example. If you were short late last week and you didn't cover at the open yesterday morning, you got blown up. I mean, and we're technically lower than where we were on Friday's close. Buying puts in an environment, even when trends are down, is just more challenging than buying calls or going long. And therefore, we're really looking inside of TTI to take advantage of high probability shorts. It's not just short the market, we're going down. It's where can we reasonably expect to find capitulation zones. A lot of that right now is coming, unfortunately, from XLK, right? The tech sector just absolutely looks terrible. It's the worst performing sector on the year right now, breaking down into multi-month lows. Part of me sits here and says that if this market is going to find a floor, it's going to have to come through tech. If you haven't stayed on top of your sector performance year to date, energy is leading right now. And it's actually up quite a bit, I think 8% on the year. And yet tech is just absolutely crushed. And therefore the markets, due to weighting with the S&P 500 and the NASDAQ, the markets are down this year. So even though we have sectors that are up, as a matter of fact, I believe a majority of sectors are green this year. The indexes are down 4 to 5%, at least the S&P is, and a lot of that comes from tech and consumer discretionary. So if we were to find a floor, just based off of math, right? Just based off of math here, if we expect the indexes to start to break back to the upside, we need the largest components to at least play ball. And right now they're not, right? We have XLK, multi-month lows, trending below a 200-day moving average, unable to stick any sort of bullish momentum. We came up here and retested the 50 RSI and then broke back down. This does not look great from a trend perspective for bulls. Now, things can change rather quickly depending on how the market takes tomorrow's tariffs. We'll talk through that in a second. But as of right now, this is a bona fide downtrend, folks. There's no other way to put it. And realistically, it's not just semiconductors, although semiconductors are potentially completing a top here on both an absolute and a relative basis. Semiconductors, by the way, I just want to throw this out here. If this was an AI bubble, this was the worst bubble I've ever seen. If you look at the majority of semiconductor stocks through something like XSD, you'll notice that a majority of semiconductor stocks didn't participate whatsoever in this bull market. So if this was a bubble in the semiconductor space, the rest of the market didn't get the memo. The rest of the industry group didn't get the memo other than maybe NVDA. It just wasn't there. I don't buy it. So semiconductors are breaking down, but it's not just semis, right? We have software breaking down as well, finding support where it needs to, but not necessarily a high conviction trade here. Previous cycle highs tends to be a pretty good place to think about potentially buying some support bounces, but the supporting evidence is not quite there yet. And then we have the other industry group within the tech sector, internet stocks, also not contributing whatsoever towards any sort of meaningful bounce. We need tech to, at the minimum, stop going down. The weightings within the NASDAQ and the S&P 500 are so skewed towards growth that if growth is not participating, it doesn't matter how well value is doing, the indexes are going to suffer, which really gives credence to the relative strength we're seeing in energy. Now, everybody is looking at this chart. Everybody has talked about this chart for years at this point. If we bring this down to a weekly, we've been building this beautiful continuation fractal after peaking at the end of 2021, right? Energy sector has not participated at all from a sector standpoint during this entire bull market. But if you're a market technician and you're looking for opportunities to take secular breakouts, I mean, you have a bullish momentum regime going back to the beginning of 2021. You have a continuation fractal playing out where we're building a base right underneath all-time high breakout. I think a move above $100 gives us an opportunity to long energy stocks for a bigger move. I'm not talking a couple days or a couple weeks. I'm talking quarters or years. These secular breakouts tend to stick for a long time. Think about secular breakouts that we saw back in 2013, right? Secular bull market in the S&P and the NASDAQ broke out in 2013 and really didn't absolutely get hammered until the COVID breakdown in 2020. But still, you can argue that that secular bull market is still intact. We've had cyclical bears, but secular bull still intact. Well, here we have energy going all the way back to 2006, 2007, 2008. We're finding resistance near the same area. Once again, back at 2014, potentially breaking out here. So we're looking to take positions in energy as a what if, as an insurance. There's relative strength here. There's absolute strength here. It's the number one performing sector on the year. Do want to point out that we've had these conditions before over the last couple of years. This bull market has had pockets of strength, of energy, and we've taken shots at the energy sector. But from a sector standpoint, it just has not yet broken out into new all-time highs. So I think as an insurance factor, taking some call debit spreads or some calls on XLE, lower your premium that you need. It's still a lower implied volatility trade, so you can really get some nice leverage in there with some calls in XLE, or you can go in and find the individual stocks that are performing well, which is what we do inside of TTI. One that we really like here, and there's a bunch that we really like, but EXE trading at all-time highs. We opened it up back at 107.5. It's currently trading at 111. Very, very basic setup here. This is an energy-related play that IPO'd back in 2021. Can't get much easier than this. Buy the all-time high breakout, throw a stop underneath the proprietary gray box, which is just the all-time high breakout. Price targets up at 130 and potentially beyond. But it's not just EXE. There's a lot of different areas of the energy sector that look good here. There's a lot that still look bad, so it's not like we just want to go and long anything under the sun. If you don't feel comfortable buying the individual stocks, doing the research, you can leverage our trade ideas by signing up, or you can just go ahead and buy some sort of sector or industry ETF. There's nothing wrong with going out and just buying some XLE called debit spreads, or if you want some higher beta exposure, you can go through something like an XOP. On an absolute basis, it's a little less bullish than XLE, but you have to assume if XLE breaks out, that the industry groups are going to break out as well, and XOP is going to have a higher beta. So you're going to get a potential bigger move in XOP if XLE breaks out. Continuing kind of the narrative here with this value play is gold. Now, I do think that gold is probably nearing some sort of contention point where we're going to get some sort of pullback here. We've had an incredible run in gold. We've been long since March of 2024. We've added in 2 different times at the 216 area, and then once again at about 245. We're currently trading at 288. We have a PT up near 297, but all 3 trades that we've put on are completely de-risked. We're up a bunch of money in both shares and call options right now. I do think there's probably going to be a pullback in gold. It's pretty extended off of its short-term moving averages. And if there's an opportunity for the market to head fake tomorrow, I would assume that if the market wants to enact max pain on market participants, they're probably going to go after the people that are buying gold late, buying value names late, and they're probably going to squeeze growth shorts, which probably, I'm kind of thinking out loud here, gold is going to be a net negative for a couple of days, potentially a couple of weeks, but still primary uptrend is intact. Very, very strong move in GLD. And then conversely, gold miners. And so I think there's a lot more opportunity here in longing some gold miners, and to a lesser extent, but still an opportunity, silver miners. Gold miners are breaking out to a multi-decade high. If you missed the gold pivot and you feel like you're underexposed in gold, I'm not saying that gold miners are particularly the best way to trade gold, but I am saying there's an opportunity here into multi-decade highs. You're not buying an overextended position. There's a couple names that we are looking at inside of GDX. We want more exposure inside of GDX, but 2 that we own right now, and I feel comfortable showing you these because we're already de-risked. AEM, all-time high. We're up nearly 200% in the call options in AEM right now. You can see beautiful base going back to 2008. It's the same idea as XLE. Draw your line at the all-time highs, buy the breakout, throw a stop underneath. You can leverage your positions with some relatively cheap call options if the implied volatility is low, and it is, or it was at least in this particular name, so we did. And then the other one, KGC, trading up into 13-year highs. Stage 1 and 2, a potential stage 2. We like it trading north of a 200-day moving average. Both of these, I don't, totally feel comfortable sharing because we're already in them and they're up rather large. But it's not just AEM and KGC. Once again, if you don't feel comfortable going through GDX and finding the gold miners that offer high probability setups, you can leverage our trades by signing up, or you can just grab exposure in GDX. I mean, this is a playable setup. Now, it's not as high beta as some of the other components inside AEM, KGC, but it's still a nice setup if you don't want to have to manage individual company risk. You could just go and buy GDX. Trends are up right now. Gold's up. This is multi-year high, or multi-decade high, and it looks good here. So energy looks good. Gold miners look good. This is not necessarily the type of stocks that you would expect in a strong bull market, but that's what looks great. And then to a lesser extent, but still needs to be talked about, China. This is still a potential cyclical breakout in China as long as we're holding above 33.5. The dollar kind of weighing in a little bit on Chinese stocks, but China has broken out. We had that big momentum thrust back in September, October of 2024, and we got the move earlier this year to get long Chinese stocks. A lot of these stocks are harder to trade because swing traders, position traders are not used to trading some of the volatility on these things. If we bring this down into the daily chart and we look at something as simple as like a JD, this is a breakout above 42, and you can see that we've danced this level for the last couple of months, but at a 3.43 ADR, that's a lot higher than some of the blue chip stocks that most people are trading. If you look at something like a Baidu, which is even more volatile, at 3.45, 5-month highs just a couple weeks ago, we're right back down to where we were a couple weeks ago. And then Baba, another one that people want to trade, 3.62. These are very, very high beta names compared to like an Apple or a Microsoft or anything like that. Not a Tesla, but you can see here that if you're trading Chinese stocks, you have to have a longer term view on these things or a very short term view. If you're trading them in the midterm here, if you're looking to target something like 4 to 6 weeks out, they can be rather challenging because they're whippy, super whippy here. They get crowded. The market tends to dump on people and then they continue in the direction of the breakout. But because you're listening to the first take here, trends are up in Chinese stocks, and until that trend gets broken, we're going to continue to look for exposure in strong Chinese stocks. One thing that we're not going to do until potentially tomorrow is we're not going to be buying the tech dip. Look at this on a tactical basis here. The NASDAQ looks like crap. The Qs look like shit. There's no other way to put it, folks. We're below the 50 RSI. We're below the 200-day moving average. We're below the July highs of last year, which is our key level to get back up and over. We need to get back up and over 497. That's it. This is not some magical level. Most people that are technical traders are probably following the same level, but this is our line in the sand for the Qs. If we're not up and over that 497 area, I'm not interested in longing stocks within the growth atmosphere with any sort of size. Feeler positions are okay. You want to take a quarter position or a half position in names showing relative strength, feel free. But full position and kind of switching over back towards a bull market mentality where you're buying dips and everything with the Qs in a intermediate term downtrend is a recipe for disaster. Now, I do want to point out really quick with the tariff conversation, I'm not an expert on tariffs. 99.9% of the people on Twitter or YouTube are not experts on tariffs. As a matter of fact, it's probably better to not listen to anybody's opinion because most people are going to end up being wrong. Having said that, everybody's going to have an opinion and a bias on tariffs, so here's mine. My opinion is that the market has priced in the worst possible thing that the Trump administration could come out and say. If you think about the drawdowns on these Mag 7 stocks, and once again, this is not my opinion based off of my econ background or kind of abstract macroeconomic analysis. It's strictly based off of technical analysis and thinking about how price has moved in such a short term. Mag 7 stocks right now are technically down. They were down. They still are down over 20%. This is your Mag 7 ETF. A lot of these big stocks, the most important stocks in the market, have been absolutely crushed over the last couple of months. It's been now. We're April 1st, and these things peaked back in December, right? These things peaked back in, December 17th, December 18th is kind of the date that continues to show up in all of these things. Now, if you think about it, it's not just Tesla, which is down huge, right? Tesla's down, it peaked, it's down huge. It's not just Tesla, though. It's Microsoft. If you look at things like Microsoft here, they're potentially completing a top. We took a short below 396, I believe it was. We're currently trading 375. You look at Tesla, you look at Google, you look at Meta, which is just now breaking its 200-day moving average, I believe. Right there, breaking below its 200-day moving average. These were at stocks just trading at all-time highs a couple of months ago, and now they're down 20+% on average. If you think about the tariff conversation, these types of moves tend to happen in bear markets, not in corrections. So if you're on the bull side, if you're in the bull camp, which I'm not necessarily in the bull camp anymore. I was, but I go by the weight of the evidence, and there's so much evidence here to suggest that we could be potentially transitioning in towards a larger drawdown or at the very minimum, a continuation of this correction phase. But I'm looking at Mag 7. They're getting crushed down over 20% on average. Thinking about the whole tariff conversation here. Has the market really priced in the worst potential announcements that the Trump admin could come out with? I think there's a possibility of that. And I do think in the short term, at least, if the Trump administration doesn't come out and rain hell on everybody, which I don't think they're going to do. I think he's posturing. I think he's setting the tone. I don't think that he's going to actually come down with the hammer. I think the market is going to rip. Now, here are the key levels, though. If the market rips and they squeeze the shorts that have been thrown onto these growth areas, we need the Qs back up and over 497. It doesn't matter how big of the move. If the Qs close below 497 and the RSI is below the 50, I'm not buying with size. It's just how the system is built. It keeps us out of trouble. I am not emotional about this stuff whatsoever. By the way, I don't necessarily care if it's a bull market or a bear market. We can make money using different strategies in either. But bull markets are more fun. Let's be honest. Bull markets are for partying. Bull markets are for buying stocks in uptrends and going and playing golf and shit like that, right? Bull markets are more fun, but that's not where we're at right now. So regardless of how the market moves, we need to see levels get broken to the upside. I do think there's an opportunity in the short term to squeeze these overzealous shorts that shorted in the hole. I think we're going to have more information, as everybody's saying, post Wednesday. Tomorrow, I think 3 p.m. Eastern Standard Time is when these tariffs get announced. So the market is immediately going to react off of that. I think the close is going to be the most important part. Tomorrow's close is going to be super important. Same conversation we had inside of the Discord yesterday. And something I want you guys to take away from this is the pros own the close. It's a very important adage in swing trading and position trading. The pros own the close. If the pros come in and they buy the close, particularly with a lot of volume, that's generally a pretty good sign for things to come. If the pros are consistently selling the close like they have been so far this year, that is typically a bad sign and a potential continuation to the downside. Yesterday, the pros bought the close, but it was just one day. We need to see follow through. And I think that comes tomorrow at the close. When the Trump administration comes out and announces their tariffs, I think the market is going to have a better understanding of whether or not the pros want to own the close or sell it more. But we need to get up and over those key levels. Once again, 497, the Qs. And then for the S&P 500, nice to see that we're finding support consistently at the 1.618 fib extension at 552, but my level is 575. It's been that way for the last couple of months. 575 in the S&P, 497 in the Qs. Unless we're trading above those, I'm not going long with size in U.S. domestic stocks. International stocks and inversely correlated assets such as energy right now, I will take full positions in, but for growth stocks and other things, I'm simply avoiding or taking very small positions in leading stocks. And I'm getting cut up. Let's be honest, Friday I got cut up a little bit. I took a position on PayPal a couple of weeks ago, and I got cut on Friday. You can see that we were building a nice base here. Had a nice little move. I was in profit, but not up and over 100%, so I didn't take any risk out. Friday, I got stopped out. But then there are other names that were showing relative strength, things like AMD. Right back to the scene of the crime, finding support exactly where I had originally opened the position, and we were able to take a little bit off on the move to the upside over the last week and a half. So some stocks are working, some stocks are not. I'm not looking to fully commit to any growth positions until the Qs prove it to me that they want to get back up and over 497. I think we're going to have a better understanding post tariff announcement tomorrow, 3 p.m. Eastern Standard Time. So that's where I'm at. You know, it doesn't sell subscriptions. I don't think people are going to rush out and say, I want to join, because I'm saying cash is king here. You don't have to commit anything. And I will tell you, if you're getting burned on shorts, it's because the dum-dums on Twitter and YouTube that are telling you to short everything don't necessarily have the money that they say they have, that they're throwing shorts on the books, because yesterday was a great example of shorting in the hole is a great way to blow a bunch of the money that you just made over the last 2 years going long in a bull market. Be very, very, very vigilant with how you are allocating your capital right now in both directions, long and short. Cash is never a bad idea when markets are choppy, and that's kind of where we're at right now. Okay, if you're inside of TTI, I'll catch you in about 15 minutes over on the Discord side. If you're not, feel free to join. We have a monthly market review tomorrow. We're going to run that at 7 p.m. Eastern Standard Time. We're going to wait for the market to readjust post-Trump tariffs, and then we're going to talk all about it. We're going to spend about an hour, hour and a half going through all of the major charts and building a game plan on how we want to position ourselves through the Q2 into Q3 post-tariff announcement. Hope you guys have a great Tuesday. Try not to